So we do see quite a bit of growth coming from new emerging and developing markets. If I take China as an example, China today writes 88 billion US dollars of premium in the non-life property casualty sector, and obviously that includes motor insurance. And if you then look at the US, which is the largest economy in the world today, they write for about 680 billion US dollars. If we do believe that China is going to overtake from the US, in 10, 15 years time, that's a potential 600 billion US dollar gap. That's quite a lot of growth potential. At the same time, when you look at underinsurance, and Lloyd's developed a underinsurance report, or wrote an underinsurance report, today underinsurance is estimated at 168 billion US dollars for catastrophic areas only, or catastrophic covers only. So again, if the whole market, if the whole industry was buying the proper insurance to protect itself, that's another 168 billion US dollars to absorb. The whole capital that's available today wouldn't be enough to absorb just that available space. At the same time, I think there is other growth coming. We do see, if you look at our 2012 numbers, we did have a 9% growth year on year. However, if you strip out the foreign exchange change, we do end up at about a 3% rate increase. So you end up with about a 3% total increase of premium. So yes, the growth is sustainable. There are lots of emerging developing markets that create new needs. New products are being invented also, like for example cyber. Now, cyber existed already 15 years ago, but the needs weren't necessarily seen by the customers in the same way. So new products, innovation, and again also new distribution channels are obviously creating that growth as well. And just in general, the growth of the economies of the emerging developing markets, as I already mentioned. There is a lot of capital around, and basically that obviously has a downward pressure on rates. When you look at just reinsurance, about 150 billion US dollars of reinsurance premium is supported by about 200 to 220 billion of capital. So in other words, you already need a major cat in order to wipe out the excess capital, and the market is very willing to ride at a 1-to-1 ratio. So there is a lot of capital. At the same time, interest rates are very low, which means that investment income for the insurance industry is very low too. And governments keep on printing money in order to keep interest rates low. So basically that environment is not going to change. I think these two elements, capital that is flowing in, and obviously capital is also flowing in because interest rates are low and they don't have the same returns that they can make in the capital market or elsewhere. So in other words, that capital is finding its way into the insurance industry. There is a convergence between market capital and insurance capital in this case. So these two elements together, I don't believe that we have a recipe today for a hard market. There will be classes that are hardening because they have suffered losses. But even then, we see that these hardenings are actually of very, very short-lived. So no, I don't think in the very near future we are looking at a hard market. In time like these, I think we should invest in both. We should invest in people and in technology. In technology because we need to better understand our data. We need to better understand the wealth of information we already have, and then use that data for further innovation, use that data to make the market and the Lloyd's market more competitive compared to other parties that are doing exactly the same, looking at their data. We should invest in technology in order to improve our processes, to improve the speed of handling claims while keeping the same quality, of course, increase the policy issuance, increase contract certainty. And so there is a lot of areas where technology can help the industry. And the industry has been actually quite a a poor investor in technology in the past, but that is changing quite rapidly. Probably the banking sector has been there before us, which was driven by a regulatory environment because they had so many reports to provide. Same is now coming to us as well, and so also for our regulatory tax reporting, investing in technology makes a lot of sense. In terms of people, insurance is people business, so we can't stop investing in people. That's absolutely of paramount importance. I think the company that does stop investing in people will lose out. So again, Lloyd's is investing quite a lot into people, whether that's in underwriting, whether that's in claims, in services. In all areas we are investing in people, also from the market, but also as part of Vision 2025, we try to attract people from all these emerging and developing markets because these markets will be the markets of the future. I think there's certainly the financial institution market changed a lot. What I think it had as an impact was far greater regulatory scrutiny. So regulation has stepped up significantly. Obviously, it has caused quite a displacement of the financial world, and so the regulator had to step up. So I think today, would still a similar event still, would that still could that still happen? I'm sure somewhere it will still happen. If it's coming from mature markets, I would be surprised with the amount of regulation we are seeing today. Obviously, with the creation of SIFIs, which are the systemic vulnerable companies. So what you do see there is certainly, as I said, an increased regulatory environment. We do also see, therefore, the insurance industry being far more professional as a result of it, introducing far more control mechanisms, far more diligence and due diligence that's going into place. Compliance has been strengthened. Chief risk officers have been introduced everywhere. So I think the insurance industry as such, became far more robust and far more reliable. It was already very robust and very reliable, and I don't think it had the same issues as the financial institutions world.